Okay, thank you all for coming to tonight's Opportunity Zone Meetup. We're now going to go into part 2 of tonight's program, and we've been talking about all the various things about Opportunity Zones and what we've been doing here within this meetup group. And now we're going to focus on yet another enhancement that we are rolling forward, which we've called a Funders Fund. But for those who enjoy lots of words, we now call it the Colorado Center for Innovation in Community Capital. We didn't necessarily pick the URLs to be that long, so we're still working on that currently. But to get started, it's intended to provide services to small businesses that need help in conducting their own capital campaigns. And in framing this, we looked at my 40-year history in raising money for hundreds of businesses and trying to figure out what's worked and not worked. And what you'll commonly see is a small business is already at the limit, time, money, and knowledge, and they don't have any stretch room to do anything more. And at the same time, when they go to do their capital campaign, it's largely reinventing the wheel. It's a custom one-off activity. I've got to do this, 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 and this, and this one time to get the money in the door, and then I throw all that away because it's not good for anybody else. And so you have lack of resources and you have huge inefficiencies. So we're trying to address both of those within this type of a service program so that there is a high probability of success for those businesses who are ready to receive capital and who have something that they bring to the community of value. In putting this together, we decided to set parameters on this where we're only going to provide services to businesses who are going to raise a minimum of $500,000. And part of that is a efficiency thing. Again, part of it is our cost, our fees to put this together suggests that it becomes prohibitively expensive to raise money in smaller sizes today. As we become better, we get more of our systems in place, we hope to be able to drop that down to $250,000, maybe lower, as a lower threshold. The upper threshold is kind of what they call the gap. If you're raising money today, you usually start with friends and family, your own money, something like that, and then you run out of money and you find yourself trying to raise in the $500,000 to $5 million range. Once you get to $5 million, if you have a legitimate ask, there may be somebody who will talk to you from an institutional level or some other level, but generally between $500,000 and $5 million is the desert of death, the death valley as it's sometimes been called, where you just can't raise money from anybody because you're the wrong size, wrong fit, and nobody knows if you're going to grow up big enough to get into the bigger leagues. But if somebody wants to raise $10 million through this service, it really isn't a big deal to go to a higher level because our costs on a $10 million campaign and $5 million aren't going to be that much different. We're going to pursue capital stacks. And again, one of the things that we recognized, and I talked with Mike O'Donnell, who's the executive director here at Colorado Lending Source, who's been kind enough to lend us this room for all of our meetings, is that today's small business typically cannot get all the money it needs from a single source. It's almost always going to be looking at 2 sources and even very commonly 3 sources of money. And anytime you start combining 2 or more sources of capital, you're creating what's called a capital stack. And invariably, the sources of capital are not working together. They're not in collaboration. They're not talking to each other. And in fact, what they're requesting of you may be in conflict with each other to the point where you can't talk to them at the same time, or you have to sequence them in some fashion, and it becomes a problem. In our viewpoint, any form of capital, cash, non-cash, from any source is a legitimate target. So in our services agreement, our clients are going to have to set a minimum goal and a maximum goal of what they're trying to raise, and they can break that out by any source of capital that's out there. We have 7 types of capital that we're looking at. So if they need $500,000 and they can get all in equity, that's fine. If they want to do $500,000 with $100,000 in equity and $400,000 in debt, that's fine. If they want to do it all through licensing or product sales, that's also fine. If they can get a property tax grant back from a local government, that also works. So we're trying to be realistic and versatile and looking at every form of capital that's out there and making sure that we can put together a capital campaign that can work with multiple sources and do it to a more elegant, lower cost of money and lower cost of raising that capital. So we expect almost every project we work with will be 2 or more sources of capital. So there'll be technically 2 campaigns going on concurrently or more to get to the minimum and maximum capital goals. Our services are going to run the full range of everything that you could and should do to raise capital. So we're going to start off with assessment of your capital needs. What do you need the money for? What were you going to buy with the use of proceeds that represents a product, service, or a person? Can we get it directly as opposed to raising money and then spending the money? But we want to make sure we got that in milestones that make sense in the progression of the business from where it's at for the near term. So we're not wanting to raise money for 5 years down the road, maybe 2, but probably not 3. Then we want to identify the capital sources. This is all the forms of capital that are out there. And again, I can talk about more types of capital than Eskimos got names for snow, but most small businesses know the bank and know somebody that's got some money in their pocket, and that pretty much exhausts their limit or range. So one of the things we're doing here is we're going to license a platform that has a matchmaking function in it. We're going to populate it with all the sources of capital that we can find. And then we're going to set up profiles so when businesses enter their own data, they can determine what they match up with immediately versus what they may match up if they do 1 or more things to make themselves meet the criteria for that particular group, which could include relocating into an opportunity zone as one of the actions that they may take. And we're going to sell this as a service outside of this particular center. So it'll be available to any of you, whether you're an opportunity zone or not. And the idea is you can go online anytime, pay an annual subscription fee, and if you want to search it 4 times a year or 40 times a year, we don't care. And it's kind of like working with your credit rating. If I do this, did my credit rating go up? If I do this, do I have more sources of capital? It's an interesting inverted learning curve for a lot of people to go, oh, I didn't know that existed. What do I need to qualify? Some things are relatively quick and inexpensive, and other things are very difficult. The third thing we do is then do a profile. And this is what we call figuring out who loves you more than you love yourself, who's going to get so much benefit from helping you out that they come out on the positive side of this. And it isn't only monetary. Again, we're looking at community impact, looking at social impact, could be a variety of things. But we want to pick the person who's most likely to do something today as opposed to somebody who might do something somewhere down the road. And that becomes the center point of the target for figuring out who to talk to. With all that in mind, we then set the capital goals. So 2 weeks into the contract, we will set a minimum and maximum goal with the client and to our satisfaction. And if we can't reach a capital goal to our satisfaction, the contract will end at that point, which is basically a demonstration that the business is not ready to receive capital or the management of the business is not ready to receive capital, if you understand the nuances there. With that, we put together a capital strategy, which is saying, here's what we're going to do first, second, third, fourth, fifth. Here's who we're going to talk to. Here's why we're talking to them. Here's what they can do for us. And with that, we'll then develop the capital offerings. This is the structure of the deal. Are we going to do an equity deal, promissory note, convertible note versus regular note? We get into rev share, licensing, whatever it's going to be. What is that deal going to look like? What can you bring to the table that matches up with why that person wants to give you money? And go down that path. With the capital offering, we then develop the capital campaign plan, what you're going to do, who's going to do it, time, schedule, budget, all the things that should be in a planning process that commonly are missing altogether from a capital campaign, where people tend to do an open-ended, I'll do whatever's necessary for as long as necessary until they die approach, which is not good planning. We'll develop the communications. So we'll talk about this later in part 3. We're going to walk you through the campaign for this center. So you're going to see all the things we're going to do. We're going to start off with classic Who do you know is the person most likely to write you a check. Who you don't know is very uncommon to write you a check. And how are you going to talk to them? Don't send them an email. Pick up the phone, take them to coffee. This is a person-to-person type of integrity relationship thing. So you're going to start there, and then you're going to start casting your net further and further afield to try to get more people who may care. But you're going to start within your networks with who you know, who has matched up according to the profile. We'll then establish communication channels so you can get that message out to the right number of people at the right time in the most efficient fashion, and then manage the campaign. That is to implement everything we've talked about here to achieve the capital goal. Because we're setting this up where we're not tied to success, but we don't get paid unless you get paid. And if that was confusing, that's perfectly okay. The center will engage a custom set of contractors, include attorneys, accountants, public relations, communication experts, anybody else that is necessary to put together the campaign, create the messages, communicate the messages, and depending upon what you're doing, there may be a number of specialists or experts, but these are all people who are going to work for the center on behalf of the client and report to a campaign manager who is responsible for executing upon this contract with the client. During the course of this, we're going to run, we estimate every capital campaign will be 6 months in duration. We're going to try to get to a point of a capital strategy and a capital goal in the first 2 weeks. And then we're going to work on development of all the materials over the next couple of weeks, and then start putting together all the pieces to stage the campaign over the next month, month and a half. We'd like to be raising money no later than 3 months into this, maybe earlier if the person has some of their stuff already together. The goal is to get to the minimum goal in 4 months and the maximum goal in 6 months. So from a business model, we anticipate that this whole thing will go 6 months, and during that whole 6 months, we are going to be educating the leadership of the organization with skills training programs that will be initially will be taught live and then live plus online, so that the person can review them at any time, anywhere. And we're going to walk them through each of these steps, why they're important, how they fit, so they can apply them to their own business and understand when somebody asks for something that there's a reason and rationale for it, and it's not, wouldn't it be nice, because if you don't do this, this is a critical element. So we'll be working through that on what looks like a 6-month boot camp. Now the good news is you'll know when you graduate, because you'll have a check called maximum goal in your bank account, and you know I must have done everything right because I raised my money, or whatever capital you're looking for. And again, we're not limited to cash, but we're just using that for simplicity's sake in the explanation. But if what you need is a new building and we get a city to give that to you, you've achieved your goal, and we're all going to move forward because you've done what you needed to do. If you need labor to do something and we can get somebody to work for you for 6 months on a deferred compensation program, we've just helped you raise capital because you didn't have to write a check to them. And we will work through all that in setting the capital goal so you understand, you know, what is it we're going to do and how we're going to go about doing it. We talked about the matchmaking, putting this platform together. We have a particular platform we intend to license, and the idea is to make sure that you're looking at all the sources of capital that are out there. And quite often, as I said, there's things you don't know about that are actually easier to get or somebody wants to give you. I learned this morning that HUD is providing up to 70% non-recourse guarantees on loans for workforce housing in particular communities within opportunity zones. Well, that could make life much easier for our project, knowing that we have that kind of a guarantee available to us anytime we go out into the field. The center will advance up to $50,000 in cost of a capital campaign. This is basically, we're making an investment in the business. We're not giving the business a check for $50,000 and hoping they can figure out how to conduct their own capital campaign. We're basically saying we'll make these people available, we'll put this money on the table, we'll cover these costs, and our goal is to get you to the point where you're successful in hitting your minimum capital campaign goal. And it is a form of investment that we're making, and we're going at risk that the business, for one reason or another, does not fall down, doesn't retreat, doesn't work with us through this process. We're going to be making recommendations to the businesses, and if we think the recommendation is strong enough and meaningful enough and the business rejects that, within our contract we have the right to walk away from the campaign in the middle of the campaign because we're basically, again, concerned that the business is not acting in the manner in which it should, which will allow us to do our job the way it should. I'll give you a great example of something that anyone who works with us is going to hear about. I ask people, do you have a board of advisors? And most businesses will tell me no, or we have one or two at best. We're going to be talking about advisors of a minimum of 10 people for each of the businesses that go through this, because these people represent knowledge. More importantly, they have their own contact networks, and when you're out trying to raise money and you're a single person talking only to your own network, too often you're talking to yourself. And if you have 10 people and they each have 200 people on average in their network, we grossly expanded who you can talk to find the people you need to be talking to. And then if we add in a board of directors, and then we write this into the contract with each of our vendors, and then everybody who's on the team that's working with you, we've now up to maybe 20, 30, 40 people who each have a network of 200 people. We're getting up around 10,000 potential people who you should be able to reach out to via one of these communication channels and go, this is what I'm trying to do, this is who I'm looking for, this is my wanted post or profile, do you know anybody who matches this? We'd appreciate an introduction. Because that's a warm introduction through a person who knows you and knows them, as opposed to picking up the phone and going, you've never met me before, but I want you to trust me with your life and your bank account. What we are going to charge our clients is $60,000 in fees and $60,000 in equity. So we're going to invest about $50,000, and we're going, upon reaching these minimum capital goal, we're going to expect to be paid back $60,000, basically a 20% cost plus 20% on cash. In addition to that, we're going to take equity of an equal amount in the small business, and we're going to take it at whatever the price point is in the offering that we just completed. So we're coming in at the same level as a third-party investor, and this comes up a lot of times in campaigns where they go, well, what'd you pay for it? Well, we came in early, like a week ago, and we got it at half the price you got it. We don't want any of that going on. Actually, I had a conversation today on one of these. Well, we want to reward you more. I says, we will not do it this way. We'll come up with another way if you want to pay us higher fees or something. But we want to be standing alongside the investors, so we are looking at it from their perspective and not being biased by the fact that we're making a sudden profit on whatever it is that we're doing. We're going to do all these services. We're going to spend money and time and out of pocket, and we're going to come back with a fee that's cash and stock. Now, in addition to that, this is where the 10-year term comes into it, because this was not a concept that was originally on our drawing board. We're like, oh yeah, so we got you through this. Now we're going to sit around for 10 years and wait to see if you're still around in 10 years so we can sell your stock, which is the big payday for us. We've essentially put ourselves, again, alongside of the investor into this business, and we don't hit our real payday until we get to the end of the term. And because we're in an opportunity zone, the term is a 10-year hold. Now, that doesn't mean that the business can't cash out earlier. We could liquidate our interest in a business because they've been acquired or some other factor comes along. If that happens, we don't distribute any of the gains from that. We have to roll that back into servicing more businesses, so the investors in our Opportunity Zone Fund meet all the qualifications of a hold for 10 years. But as we were looking at that, we're going, well, what we need to do is we need to put in a support mechanism, kind of like selling software and then having tech support to make sure that everything's running okay for the full 10-year period. So we're now also going to do an annual checkup. We're going to charge $2,500 for that. We're going to take the capital strategy, the matchmaking, everything we've done, and we're going to update it. So essentially, we're going to meet with you. We're going to say, we reviewed your situation. Here's all the things we see now that have changed or that you may want to look at. You may now qualify for new types of capital. It may be time for you to do your next capital campaign, or maybe you should make some more changes in your operation because you're offline. You're not going to be here in 10 years. And we're going to tell you about it because we're standing there with the rest of your investors, and we're trying to give you a warning that we don't want you to go off the tracks. We want you to be still in existence 10 years down the road. So this will be a meeting with a capital coach. We're going to have this executive director, which is the role that Ron's going to play in the center. We're going to probably end up with 3 different campaign managers, each managing no more than 4 campaigns at a time. We don't anticipate having more than 12 campaigns live at any particular time. And then once you get successfully out of your campaign, you'll be assigned to a capital coach who will sit with you through the 10-year term until we can liquidate your stock position. And their goal is to make sure you get across the finish line successfully so that we have our big payday at the back end. One of the things that we're going to do, which is, as far as we can tell, is not maybe novel, but close to being novel, is we're going to require every one of our businesses, clients, to set up a sinking fund. And every year after their capital, every month after their capital campaign, they're going to put $1,000 into that account for 120 months or 10 years, so that at the end of the 10-year time period, if they don't have cash on hand, and we cannot sell our stock into the marketplace for one reason or another, we get to tag this and elect by option for them to buy us out of the stock that they gave us 10 years ago at twice the amount of money that we took it in value. So that's about an 8% annualized ROI, but it gives us a form of guaranteeing an outcome, and at the same time, it is creating a savings account for the client. If we turns out we can sell the stock into the market one way or another at a higher price point, we turn the keys over to this account to them, and they get all the money that's in the account. We're going to take a secured interest in this, so this is like an escrow account. If there's some reason the business falls apart, there's other issues come up during the 10-year time frame, we can call that account and we can cash out at that particular time and walk away from that particular business. But this is going to be a way where we can have some assurance that we do have an exit down the road, because 10 years is a long, long time. Our goal is after 10 years, we'll start selling off the equity that we got from the businesses. So right now we're looking at doing a $600,000 raise. $500,000 of that will be dedicated to doing capital campaign services. And at $50,000 a piece, the math is we expect to be doing about 10 campaigns every 6 months, or 20 campaigns a year. That means then at 10 years down the road, we'll be sitting on stock in 20 different small businesses, and we're going to liquidate that stock for that particular year. And then the next year, we're going to liquidate the next 20 and the next 20. So we're going to start cashing out of the zone after the 10-year hold to qualify for Opportunity Zone tax incentives, but we're going to do it in a controlled fashion over a period of an additional 10 years. So this is actually, by some people's standpoint, a 20-year investment that's being made. Now, our initial projection is that we'll hit a capital payback within the first 2 to 3 years. So the investors will receive ordinary income distributions that will match their original investment. And then a couple years after that, we'll hit another milestone where they've doubled their money. And then they're looking at participating for the life of the project. In this case, our goal is to get a minimum of $120,000 back on $60,000 of equity 10 years down the road. We have talked about, and we are looking at the option of creating an exit capital raise, where we bundle up all the stock of all the small businesses and calculate their net present value and sell that to another group of investors so we can create immediate cash exit for everybody at the end of 10 years. And we'll probably do that, but do it under an option format where if the investor wants to hang for another 10 years, they have that ability to do so, or if they want to cash out, they can at the end of the 10-year period. So that brings me to the end of this second part. And I'm basically just been going through the services. This is what this center is going to be doing, the different elements that are involved with that. And in the next section, I'm going to get into the structure and organization of the offering, how we're putting that together in order to raise the money into the center. And then in the last part, we'll be talking about the actual capital campaign, how we're going to raise money into our two capital campaigns so that we can get to our $600,000 goal for this. So does anybody have any questions at this point in time on what this center is, what it's going to do, how it's going to perform its services, how it's going to charge fees, any of those kinds of things? Yes?
Do you control that sinking fund? Or the escrow account, is that under your control? Or?
It'll be set up like an escrow account where it'll have to be a dedicated bank account at an institution that's agreeable to us. We will hold a secured interest in it, the lien against it, so they can't take anything out without our control. So in one sense, no, it's not under our control, but they can't do anything with it either. So it's a pledge against their capital at that point.
You file a UCC one against it, right?
Yeah. Yeah, it'll be all papered up so that in the event of a bankruptcy or any other failure of the business, it's clearly ours and not somebody else's. Other questions? Okay, we'll take another 5-minute break at this point.